All right, let's dive right in. Today, we're going to unpack a book that is, and I'm not exaggerating here, one of the most important investing books ever written. We're talking about Benjamin Graham's The Intelligent Investor. It's basically the Bible of value investing.
So here's the big question, right? The one that probably keeps you up at night if you've ever thought about investing. How on earth do you protect your money in what feels like total market chaos? I mean, it could feel like a storm out there. But what if there was a real framework, a proven way to not just ride out that storm, but actually come out ahead? A way to protect your capital and let it grow steadily over the long haul? Well, that's exactly what Graham gives us.
But first, let's get one thing straight. This is absolutely not a get-rich-quick scheme. Graham's whole philosophy, what we call value investing, is a logical, time-tested strategy, and it's really all about two main goals. First, preventing you from losing your shirt, and second, achieving good, solid, long-term returns.
Now, before you even think about buying a single stock, Graham forces you to ask yourself a huge question. It's a fundamental choice. Are you an investor or are you a speculator? Trust me, the difference is everything.
Okay, take a look at this definition, because this is where Graham draws a really hard line in the sand. He's super strict about it. For something to be a real investment, it has to check 3 boxes. 1, you've done your homework, thorough analysis. 2, you're confident you won't lose your initial investment. That's safety of principle. And 3, you expect a decent return. Notice he says adequate, not get rich overnight. If you're missing even one of those, guess what? You're not investing, you're just speculating.
And this really lays out the two different mindsets perfectly. See, the investor is buying a piece of an actual business. They care about what it's really worth. The speculator, they're basically just betting on squiggly lines on a screen, trying to guess which way the price will jump next. So the key takeaway here is simple. You have to know which game you're playing.
So how do we deal with the crazy ups and downs of the market? Well, Graham gives us this incredible little story, an allegory that makes it all make sense. It's time for us to meet a guy he calls Mr. Market.
So just imagine for a second you're in business with this guy, Mr. Market. You both own a piece of a company, and every single day, without fail, he knocks on your door to talk business.
But here's the thing about your partner. He's an emotional wreck. His mood just swings wildly from total euphoria to absolute despair. And these mood swings completely change how he thinks your business is worth.
So on his good days, he's just bursting with optimism. The sky's the limit. He'll come to you and offer to buy out your half of the business for a price that is just insane, way more than it's actually worth. He's totally manic.
But then on his bad days, oh boy. He's completely panicked, he's convinced the world is ending, that your business is doomed, and he's so desperate to sell that he'll offer you his shares for practically nothing, just pennies on the dollar. And here is the whole point of the story. The intelligent investor never ever gets swept up in Mr. Market's moods. Instead, you use him. You take advantage of his pessimism to buy from him when he's scared and selling cheap, and you might consider selling to him when he's euphoric and offering you a ridiculous price. You're in charge, not his emotions.
So how do you actually use Mr. Market's mood swings to your advantage? This brings us to what might be the single most important concept in the entire book. Graham calls it the margin of safety. These 3 words are the golden rule.
All it really means is this: never overpay for anything, ever. It's about figuring out what a business is actually worth, its real, intrinsic value. And then you insist on buying it for a lot less. That discount, that gap between price and value, that's your buffer. It's your cushion against being wrong, against bad luck, against a market crash, you name it.
And here's how that works in plain English. It's super simple, really. Let's say you do all your homework and figure out a stock is truly worth about $100. You don't go and buy it for $99. No way. You wait. You wait for Mr. Market to have one of his classic freakouts and offer it to you for, say, $60. And that $40 gap, that's it. That's your margin of safety. It's your cushion, your protection, and honestly, it's where the opportunity for great returns really comes from.
Okay, so you get the theory. How do you actually put it to work? Well, Graham says you need to decide which of 2 paths you're going to take. You can either be a defensive investor or you can be an enterprising investor.
The defensive investor, their main goal is just to avoid messing up badly and to keep things simple. Think broad diversification, like buying a simple index fund and calling it a day. The enterprising investor, though, they're willing to roll up their sleeves and do the hard work, the deep dive research, to find those hidden gems and hopefully get better returns. The most important thing is to be brutally honest with yourself about how much time and energy you're really willing to put in.
And Graham is crystal clear on this.
He says trying to be some kind of casual, half-in, half-out stock picker is the most dangerous thing you can do. You either commit fully to the work of the enterprising investor, or you embrace the simple, hands-off strategy of the defensive investor. There's no safe in between.
And all of this brings us to the most powerful idea in the whole book. After all the spreadsheets and all the strategies, Graham tells us that the biggest enemy you will ever face in investing isn't the market, it's not a recession, it's not a bad stock, it's you. The battle is internal.
See, being a successful investor isn't really about being the smartest person in the room. It's about your character. It takes iron discipline to stick with your plan. It takes patience to wait for the right opportunity. It takes critical thinking to not follow the herd, and maybe most of all, it takes the emotional stability to just ignore Mr. Market when he's screaming in your ear.
And that really is the final lesson of the intelligent investor. This book isn't just about finance. It's about temperament. The market is going to test your character every single day. So the real question isn't, what's the market going to do? The question is, what are you going to do? Are you ready?